Welcome to Trade Pro. I'm talking about how spreads and commissions can greatly affect your trading results, especially if you're trading on lower time frames. So let's get into it. I'm on the Forex.com website and I have up a few different types of accounts that you can use through them. First, there's a standard account, which is probably what most people are using. And I want to tell you why it's dangerous to have a high spread account and why a low spread with as low of a commission as you can get account is better. Commissions over spreads, and I'm going to explain to you why I believe that is the case and why I prefer a commission over a high spread. Okay, so let's get into it. Standard account for Forex.com. All they give you is a spread. There is no commission or fee. All right. So euro dollar, as low as 1 pip spreads. Euro dollar, it's not as big of an issue as other currency pairs. Okay, I'm going to go in and view some of the other spreads and then show you some visual examples on TradingView so it fully drives home the point that I'm trying to make. Then there is the commission account, which has low spreads plus a fixed commission of $5 per one standard lot or $100,000 traded. So very low spreads, 1/5 that of the standard account. And this makes a big difference. I'm going to show you why it makes such a big difference when it comes to your bottom line and your overall trading results after a series of trades. Then there's the Pro, which has extremely low spreads, 1/10 of a pip on most major pairs, and then variable commission rate. I think most people are going to be looking over here on the commission and standard, unless you have been trading for quite a while and you are trading in the millions. Okay, so let's go over to some examples so I can show you the visualization. Actually, first I need to go in and show you the different types of spreads here. So first of all, as low as 1 pip is not really what you're going to be getting when you're trading. You're going to be more looking at that typical rate. Okay, so 1.5 pips for euro dollar, and these are all highly liquid currency pairs. So it gets much worse when you are dealing with less liquid currency pairs. You can have very high spreads. Okay, so keep this in mind. I'm going to now go into an example showing you on euro dollar and on New Zealand Canadian dollar. Okay, or Kiwi Canadian dollar, whatever you want to call it. Don't get mad at me. Okay, so here's euro dollar on the 1 minute time frame, and this is the typical spread, 1.5 pips. And this is visualizing what that 1.5 pips is. So you're getting a worse entry when you enter. That is your commission, really. It's just that you get a worse entry. So let's say you get a signal to enter a short position. You have a move down followed by the sideways consolidation, and then your system gives you a short entry. Okay, so you think that you're entering right here, but you're actually entering down here because of the spread. So you're getting a worse short entry position. What that means is your target might not get hit if it's a close call. And what I'm saying is on euro dollar, it's not that big of a deal with such low spreads. It's not going to be that big of a deal. As you can see, it really isn't that crazy. Okay, so let's zoom out to a 5 minute because that's a worst case scenario if you're trading on a 1. And it really doesn't look like much once you zoom out to 5, 15, 30, and so on. Okay, so it's really negligible at this point. So euro dollar, not too bad when it comes to spreads, unless you are on a 1 minute time frame, then it will make a difference. So now let's take a look over here, Kiwi Canadian dollar, where the spread, typical spread, is 7.3 pips. This is a visualization of that. And you can already see on the 1 minute time frame how much bigger this is compared to that example on euro dollar. This getting this much of a worse entry is really going to affect your risk to reward ratio and having your target get hit. Like, this is a significant move. It's larger than this huge candle over here. So you really are going to need to be careful on the lower time frames when you're getting to these types of spreads. And this is the point I'm trying to make here, okay, of why commissions can be better than spreads, because at least with commissions, you still can get your profit target hit. This is going to make it so you're going to have a much worse entry. So maybe your signal got you in on this candle, but then you thought you were entering right here, but your actual entry is all the way up here after half the move is done. And then, it just is going to be a lot harder. Over a series of trades, you're going to have a lot of instances where it doesn't hit your profit target because of that bad entry on the spread. So you can work around this, but personally, I am a fan of commissions because of this reason, where you're going to be getting in much worse position than you thought. And it can also affect your back testing compared to real-time results. Okay? So it's important for the reason of getting your profit target hit. Even if you have a commission, it's all right because at least you still got the profit. You'd rather have a small commission taken off and get the profit from your trade than to just entirely lose the trade because of the horrible spread, and it never even hits your profit target and results in a losing trade. Okay? So hopefully I've made the point clear that I'm trying to make. I don't know how else I can explain it. I'm no expert on explaining things or teaching things to people. I just know from my experiences with trading that it can wreak havoc on your bottom line if you are dealing with high spreads. Okay? So hopefully I made the point clear. Thank you for watching, and have a nice day.